Okay.
Good. So, hi everyone. Good evening. Welcome again this session. So today we have with us Shashank Dogra, an opportunist investor who keeps the flexibility to use multiple strategies in his framework. He started his investing in the year 2018, and we have had a very interesting session in the past with Shashank, wherein we discussed how retail can benefit from the low base capital, which majority of the participants think that is an hindrance. But again, that how we can put that to our advantage. And we also discussed about the 100x portfolio formula, wherein we discussed about the maths to it and how we can confluence different strategies to start with, from like value investing, techno fund approach, and looking for the factors in momentum investing. So the inflection point where all these strategies converge is something where you make non-linear returns, and definitely we can touch upon this topic a little bit more, wherein we discuss about the value chain, wherein we discuss about the promoters and institutions and retail, how we are at advantage in comparison to other players in such situations. But again, today we would be discussing framework for capital markets. So to start with, would appreciate Shashank if you can start with a opening note and run us through the presentation, and then as and when we have questions, so definitely we'll ask those questions.
Sure. Firstly, thank you, Prince, for such a generous introduction. So, as you said, we discussed last time on the basically a strategy where a retail investor can basically use different frameworks of investing, and over there we majorly discussed around how a smaller portfolio can gain an edge and what the strategies they can apply, especially on the concentration side, to basically make considerable returns, which basically moves the needle. So today's discussion would be more around framework for capital markets, because what I believe is that when I started investing in markets, what I used to struggle was to understand who's doing what, because there are multiple participants in the market, right from intraday traders to ultra long-term investors and short-term positional traders and everything. So what I used to feel lost was where am I placed? Because every strategy was working at certain time and was not working at the other time. So that used to be a struggle. So I thought I would lay down my framework, that how I used to think and still think, of course, about capital markets. And yeah, we'll like like discover this sequentially.
Perfect. So, Shashank, I mean, we can start with the small presentation, and definitely you can run us through the pointers which you have highlighted and share your thoughts around that. And definitely, as and when questions pop up to our minds, I will stop you and ask those questions.
Right.
Otherwise, there would be a Q&A at the end of the session for sure.
Yeah, that makes sense. Perfect. So let's start the presentation, and let me dive down into it. Just a moment. I'll just take the video off so that we focus on the content. So see, I mean, when we all join the capital markets, especially the stock market, we always have this question, and there's always a debate around who are we? Are we an investor or a trader? And traders are have a very bad reputation, and investors apparently have quite a good one. And the longer ones who have stayed in the markets apparently seem to be investors, or what they call them, investors. But for me, what my experience says is that uh, I personally look at investing at only in things that stay with you. Like, for example, anything that stays with you for life is an investment. So that would be, let's say, your skill set, that you are, different skills you are learning, because you can't, like get rid of those, of course. You can add to different skills. Then secondly is your health. So health, anything that you do towards your health is going to, like, stay with you till the time you're alive. So these are the two elements which I personally consider as investment. And everything else that can be sold within your lifetime, or that can terminate within your lifetime, is basically a trade. So that's how I see both life and investment. So this is, I think, one aspect that everyone needs to be very clear about, because sometimes what happens is that we are, at the end of the day, we are capital allocators, and for capital allocation to get it right, if you the last thing that you want is confusion in your mind, that whether you are an investor or you're a trader, or what exactly are you doing in the market. So I stay very clear on this front that I am a trader, and I position myself accordingly, according to the bets I get into. So diving a little deeper into this, now let's first say that you are a trader. Okay, fine. Now, in the aspect of being a trader, who are you? Like, because there is a value chain of investing, or trading, whatever you can call it. There are multiple participants right from the beginning toward the end. Capital market resemble basically nothing but a jungle, where organisms and the animals over there have a lifespan and traders time span. So this is very critical aspect to understand, because once you understand this part, you will understand that it's an ecosystem where every person has the right to execute their strategy, and no strategy is a bad strategy. Successful trading is basically nothing but to be right within your time frame. That's it. You choose your time frame, and if your opinion is right, you make money. Simple. If you're clear with your time frame, no matter what you do, is a good investing or a good trading. So to start with, let's start this value chain. What, like, it looks like. Basically, you start from is an intraday trader. So these guys are like, are like, you see these mosquitoes, on the bright light, that they live basically just for a night. So I would resemble, if you look at the an ecosystem, I would compare it to that one. So intraday trader, if someone wants to really understand who an intraday trader is, I would recommend this site Amplify Me. It's a UK based training platform. So what these guys do is they basically teach you how to do this intraday, how to basically to understand what this game of intraday trading is all about. So in short, if you go to the website and just for sign up for a free demo, or you can say a simulation. So what they do is they would sign you in, and they would basically make you a dummy bank trader for, let's say, 1 hour. Okay. And in that time, you will be getting orders. Like, for example, so let's break this down a little bit more. Who is basically intraday trader? Intraday trader is nothing but a trader sitting at a brokerage house of a bank who is executing the orders. So let's say I'm a trader. Okay. So what I do is I get an order. Okay, some hedge fund or a mutual fund guy is calling, and that fund manager wants to buy 10,000 shares of Apple or Reliance. So what would they do? So what these hedge funds and mutual fund guys do is they run an algo, and they see that if I buy this 10,000 or 100,000 shares right now on market, let's say Apple is trading at, let's say, $150. So if I go right now in the market and punch the order of 100,000 shares, my average cost of this per trade is going to be, let's say, 155, because I will move the price by buying such high quantity. So what these guys do is they call up the broker, And the broker, they would say is that, listen, my cost is coming out to be 155. Do you have any better proposition? So this guy would do is they would run their own algos. They have their systems. They would say that, okay, at 153, 100,000 Apple shares yours. So this guy will say, okay, perfect. So I'm basically, saving 200,000 because it's $2 less. So they would close the deal. So now this particular person who closed the deal, he would go to the trader and they would be given a task that you have to buy these many shares, like 100,000 shares, at an average cost below 153, which they have committed because that's how they will make money. So the trader's job now is to take price up, down, whatever, and eat the stop losses and ensure that they get the brokerage house is able to get 100,000 shares of Apple at below 153. So this is the game that is being played, on a larger level. So you need to decide whether do you want to play this game or not. If you really think you can mimic the investing style of this kind of a trader, please go and be an intraday trader and make money and be happy. Don't listen to anyone. So my objective was today to basically tell you what this guy does. Now, second one you would have in the value chain is a derivative trader. So a derivative trader basically is nothing but who's actually, running on the options or the futures. So what these guys do is basically these instruments are to hedge. So in a let's say in a world of where we can say we certain people would have some different level of information arbitrage. So if certain people, let's say, have a different opinion on a longer or a shorter term time frame due to some kind of a news, so these derivative trades get placed in that manner, right? And a derivative trader is basically nothing but what they're doing is they are trading on the underlying security, right? So the underlying security in this case would be any stock or the index. So ideally, the these active derivative traders are the ones who are holding the amount in cash. Like, for example, let's say I'm trading Reliance. So they would the a brokerage house that is trading Reliance would always have, Reliance cash delivered share in a very decent quantity. So what these guys would do is first they will make a position and take a position of a particular stock, and then uh, of course, having a particular opinion. Then post that, they can use the cash amount shares to move the price. So, for example, if I am actually creating, let's say, a bearish position on Reliance, okay. Now, let's say I if I have a bearish position on the trade, of course, I would not want anyone else to make money. I would not want the stock to go up. So they would position it in a way that they would be, they would have enough quantity to sell. Now, if you look at the leverage percentage, they have roughly 8 to 10x leverage on that. So what that basically means is that even if they lose money on cash, they would make substantial money on the options or the futures. So again, if you think you can beat the market or beat that kind of a institution at their game, please go and be a derivative trader and understand the rule of the game. And if you think you're doing it right, you know you're free to choose. Now third one comes out to be a positional trader with a time frame of, let's say, 1 to 15 days. So these are the players basically who have this information, and they are people who run, who have a lot of money, A lot of means like, they have huge chunks of capital to deploy, but for a shorter duration. So either this money is levered, it means they would borrow it from the bank or the NBFC or whatever, and they would know that there is a news coming in a particular stock, and they would take a position accordingly. So one is this kind of a trader who would just place for the pops, you can say. Now, another one that you would have is a positional trader with a view of 1 to 3 months. So this is what you also call, like, if you know that some company is about to post some decent earnings, right? So they would get to know that either through industry knowledge or through, like, channel checks and everything, and they would take a relatively longer position in a particular stock. So this is what you call, a paid pop-up trade. So with a duration of 1 to 3 months. Then you have a trader who would be there for 1 to 1.5 years. And this is the person who basically wants to play the entire cycle of earning growth. So they are basically in to, whatever trigger that has led to increase in the earnings, they want to get the maximum and the full benefit of that trigger. So they position themselves for every position for 1 to 1.5 years on an average. Then you have a long-term trader, and a long-term trader would have a business cycle view. So business cycle would be like, they would be keeping an eye on the capital allocation of what the supply side is looking like and what the demand side is looking like. They would analyze the discrepancy, and eventually, they would take the position accordingly. So they would have a business cycle view. And there's a very good book on this, written by Edward Chancellor, called the Capital Market. Uh, I think, yeah, I think it's something like that. Capital Returns. Sorry, Capital Returns is the name of the book. So if you're interested in this part, you can actually refer to that. Then you have ultra long-term trader. So these are basically subject matter expert. So subject matter expert, venture capitalist, private equity. I mean, private equity, I would not say, but private equity generally these days they have a horizon of 5 years maximum. But these are, this ultra long term guys are basically are the ones who have decadal views. So they are in for a mega trend. So they want right from the beginning till the end the full earning, potential from that idea, from that, the business, from business cycle to be to whatever you can say. They're just in for the long term, and these are typically people who are with a very high capital base, and their capital makes them patient. Their capital size makes them a long-term trader. Even if they have a choice to be a smaller one, they cannot be. So yeah, that's the the ultra long-term one. And the right strategy, and that's the most critical point. So right strategy for any investor who is trying to position themselves in a market in a profitable way is has to be aligned with your capital size and personality. Some people by nature are not very patient. They are looking for a trigger, and they are very good at finding another stock with the similar looking trigger, and they find it very exciting. So for them, there is no harm in basically being a positional trader with a smaller time frame view. And to be honest, with a smaller capital size, you have the luxury to execute that. Now, whether your circumstances, whether your personality, whether your capital size permits it, that's your personal, take. No one has the right answer but you. But my point over here is that there is no harm in trying a particular strategy and trying, I would say, different strategies where you can find your sweet spot. That is, my main point over here. So now, let's address this issue that then why do we see on Twitter or like, on spaces and everything, there are a lot of people are, conflicting, have viewpoints. Your stock won't do good. He's pumping his stock. He's doing this, he's doing that, and everything. So basically, what I've observed is conflicting viewpoints are nothing but overlapping time frames. A guy who has an ultra long-term time frame, 3 to 10 years, or even let's say more than 10 years, right? This guy would find a 1 month feed pop-up trader an idiot. He would say that you have an opportunity to make 10x your money, but you are only there for let's say 40% return, right? But this guy can actually this the positional trader for 1 to 3 months or 1.5 years, whatever you can say. This guy can repeat his process 10 times, right? So this guy can make, like, if he is good at his game, he can make much more than that, like 10x or 20x that the long term guy would make. But there is always conflicting point of view, and what happens is that in this whole conflicting viewpoints, people get lost, especially the new investor who's coming to the market. That what is the right one then? This guy is saying this is not right, the other is saying that is not right. Do not listen too much to anyone. Follow yourself and see what is working for you. That is the right way. You should know, you should know that if you are looking for a particular time frame, you got to remain within that time frame for that particular trade. Just respect your time frame, decide your time frame first, then start looking at options to invest. So that would be one of my suggestions to people. And over here, if you really want to understand how this, multi-time frame views are blended together, there's a very interesting book by Brent Donnelly. It's called Alpha Trader. I really like that book. They basically explain you if you are, let's say, a trader in the bank or a hedge fund or a portfolio manager at a hedge fund and things like that, how you think about your money. How do you look for triggers? How do you look for, like, what kind of information do you look for when you take a view? And what kind of information do you look for when you have to, let's say, when you need to go against your view or close your position? So it's a very good book in case anyone is interested. So Prince, I'll just stop here in case you or anyone has any question.
Good to go, Shashank. You can continue. We'll ask questions as and when we have. And for our participants, they are free to send in their questions in the chat and they can raise their hand so that I can unmute and they can ask questions to Shashank. Yeah, Shashank, over to you.
Okay, perfect. So I'll for the moment I'll continue. Now let's talk about risk equation. I think this is a very critical aspect because this comes into your way in your investment strategy. This would also come into your way when you're going to be allocating, like doing allocation and everything. So you need to have a very absolute clarity on what kind of risk you're willing to take and how to look at risk. See, a venture capitalist with a very long-term view of things, for them, it is probability of success multiplied by degree of impact. So now, if you look at all the innovation that happens, and people who are actually hell bent on a particular idea and make it success, for example, Elon Musk, what they look at is degree of impact. For them, degree of impact decides everything. Now, probability of success can be low, but it should not be zero. So, a risk equation gets, a decent value when degree of impact is large enough to compensate the lower probability of success. And when you look at the fund manager, which is more on the public market side, where the public equity is being traded or invested, What these guys do is they manage risk, but returns are automated. They are running on this principle that you just are we are risk managers, the returns will automatically come, which is in their own way they are right. Now you need to understand one thing as a retail investor with a small capital, the sweet spot for you is somewhere in between, because you would if you are looking only at managed risk and return and automating returns, you're better off investing in a mutual fund or or rather let's say an index fund. You would get those returns. You need not put your time into this. What you need to do is, of course, you need to manage risk, but at the on the other side, you need to look at the degree of impact. The degree of impact would actually say that any stock that is not loved by the market, but it is showing a turnaround, which is it's lying in the pessimist zone. Earnings are there, and all the fundamentals and technicals are aligning. Take a bigger bet in that case. Now, degree of impact can be understood in two ways. One is that you can think that the degree of impact is going to make as a business itself, and the degree of impact that is going to make on your portfolio, right? So you need to understand that degree of impact has to go to two-way. That the business should have a decent degree of impact, in its performance, and it should also move the needle for your portfolio, where for which you would have to allocate more, and ideally allocation more, when allocating more, prefer always to go for averaging up rather than going all in. And most advisable would be to go once the earnings have showed up at least once. So that is a time where you need to basically push the trigger. So, and on this, if you really want to understand the risk taking frameworks, that how you basically think about risk, how the people who have made disproportionate amount of success, have tasted disproportionate amount of success from their bets. You read this book, On the Edge. This is The Art of Risking Everything by Nate Silver. So this guy basically what he does is he invites people and he interviews them for these are basically poker players. They are sports players. They are like from the different field of investing. Of sorry, different diversified fields who are dealing with risks. So he tries to unfold how these guys think about risk, and he also interviews a lot of venture capitalists and all these people who deal with risk every day, and of course fund managers also. So it's a good book to develop a framework and to develop a framework towards risk. So yeah, I mean in Hindi you say that like मरे बिना स्वर्ग नहीं मिलता. So that's the same thing. यहाँ पे भी you would have to take high risk in order for you to make high return. So that is the the larger message over here. Now moving on. Uh, Now if we move on to this element, SME, I think you would have seen a lot of people having this debate that whether the SME is right or not. So in my opinion, I think first thing we got to do is have your own opinion. Do not go by anyone's opinion, whatever they are saying. Whether they are pro SME, whether they are against SME or anything. So SME sector currently in India is at a very, very interesting junction. And I firstly want to take you to this book by Mr. Our Minister of Foreign Affairs, External Affairs, Mr. S. Jaishankar. and his book is called Why Bharat Matters. So in this book, I just took two, quick screenshots. And here, if you see what he's explaining is that India in the last 3 decades, right? They have, you know, we opened up our economy in the 90s, right? We attracted all the foreign capital and everything. But I'm just quoting this book to this line here. In the name of efficiency and modernity, easy options were taken at the expense of for small and medium enterprises. In the last decade, we have awoken to the realization that mantras about globalization, if mindlessly applied, can cause real damage. Right? So, what does that basically tells you? That the leadership of this country is has absolute clarity that the growth that happened in the last 2 decades or 3 decades, right, is not going to be the same type of growth that we are going to see in the coming decades. Not from the same sectors, not in the same way. So they're absolutely clear that this government is designing policies that which are pro SMEs, which are going to have an inclusive growth, which is not going to have, let's say, they are not interested in making India the market of the West, which is what we have done in the last 2 decades. So I just want you to sit back and think that we are on one side geopolitically facing such a situation that US has high debt, and the world is getting multipolar, and every country is taking measures to to strive growth in their own countries. What is India doing? India is actually looking for inclusive growth. So inclusive growth does not just mean that your per capita GDP has to increase. See, per capita GDP can also increase if I increase the disparity between the rich and the poor. If the rich are extremely rich and the poor are extremely poor, you would still get a very high per capita GDP. But that's not what we are interested in. That's not at least what Mr. Jaishankar is interested in. What they want is they want an inclusive infrastructure driven growth. And for that, you got to include the SME sector. And that is very clear. So one thing is for sure is that the message from top down is very clear that SME growth is there, is is here to stay. Now, on the other hand, I would like to just draw your attention on what has happened on the financial terms in the last 2 decades. Now, if you just see what was happening, let's say I'm a businessman in India. Okay. What used to happen was I want to do business, so I need growth capital, and there is no SMEs, no I cannot go to the market and raise capital, so I go to the bank, right? So I go to the bank. Let's say my business is making 30% return on capital, 30% ROC, or let's say 25% ROC business. Okay. Now, out of this, 30% that I'm making from the business before interest, of course, 12% interest I'm paying to the bank just on the platter, right? And the remaining is with me. Fine. And using that much money to reinvest in the business, I'm growing my business. Now just take a step back and just think about it. What just happened? You gave 12% to the bank on the platter for providing you the money, which is the growth capital. And who's the actual owner of this bank? Let's say, for example, HDFC Bank or any other, bigger bank. Most of these banks are majority owned by foreign investors. These are FPIs, these are FDIs. So, what is basically happening is the growth of this country, at least half of the money that they are making through business is being offered through this platform called bank to the FIIs, right? And how do you think an India would actually ever make this kind of how would you think that in a country like India, where 12% of the returns are like given on the platter to a bank, how can this SME guy become competitive in the world? He cannot, right? So what is then the way out of this? Way out of this is SME investors who are coming in, they should be trained first of all to find the right investor, and once you find the right entrepreneur, and once you find the right entrepreneur, bet your capital with them, right? How does it serve in developing India as a country? Firstly, this investor who is giving capital to the entrepreneur is in India. Any returns he would make would be taxed in India, right? The money stays in, the entrepreneur becomes more competitive. Now, let's say in this case, there is an SME guy who is making 30% return on capital. Now, instead of borrowing it from the bank, he has actually taken this money from a risk investor. He has done a QIP or anything like that. So in that case, both the investor and the entrepreneur, you know, will get to retain that 30% instead of, just giving it as an interest cost. So you got to understand one thing: if the country has to grow holistically, SME as a platform is critically important. And you cannot put, blanket bans on this kind of investing. See, SME investing in India has both economic and geopolitical significance. Economic significance, I just explained you. How? By retaining the money made by the businessmen, by mutually sharing between risk capital coming from the investor and the entrepreneur is the right way to, have a flourishing sector, flourishing business ecosystem. And on the second hand, there is a geopolitical significance. In a geopolitical significance, it is like it's in saying that once you are looking at critical supply chains of things, of let's say technology, or let's say energy, you would develop, like China has developed, a local ecosystem which can cater to that in case the foreign powers are twisting your arms. So that is like, if India has to become a superpower, that is critically important. Now you would see, like, a lot of investors on Twitter, and, a lot, they would come here and put blanket bans. Like, oh, SME investing is for the frauds. 80-90% companies are frauds here. You should stay away from it. I mean, this is basically serving no one, right? And if they are experienced investors, if they are like anything worth their experience, they should be asking you to focus on those which are the right companies, giving you the frameworks for analyzing the right and finding out the right one, rather than empty debates of everything is bad, everything, you don't touch them, you will burn your hands. I mean, you can burn your hand anywhere, right? Fine, probability could be higher in SMEs because the you would not have those some variables and all, but discouraging SME investing is what I'm against, because it is critically important for both, for us as a country and for the financial ecosystem. SME investors are the bank we need. We don't need the banks who lend money to the SMEs. What we need is SME investing community, that should be the bank, because this is where everyone makes money. Doing right SME investing, encouraging to pick the right winners at right valuation, this is what we should be promoting. So the larger point I'm here, and what I'm trying to draw in is, look at where we are as a country, look at where we are as, like as a geopolitical power center. Once you understand our geopolitical and economic positioning, how India is trying to position itself, you would understand the importance of SME investing. So for that, I mean, I would highly recommend you to read this book by Mr. Jayashankar, Why Bharat Matters. There's another one which is called Kautilyanomics by S. Balasubramanian. And I would highly recommend this book, Power Within. It's on Narendra Modi and how he thinks. and this is by Bala Subramanian. So, yeah, these three books will actually explain you what the leadership is trying to do and how they're trying to basically position India as a country and how they want inclusive growth, where the per capita GDP increases by equal distribution of wealth, not just like, one section, not just the rich getting richer. We are seeing, the outcome of capitalism in the West, where the disparity between the rich and poor is now growing. So that basically, that kind of a system basically collapses. I mean, India used to have 25% of the global GDP. We used to contribute 25% of the global GDP in the 11th century. Can you imagine that? And the entire system in the country was based on inclusive growth. There was no such thing called poverty. There was everyone used to be an economic beneficiary in the value chain. So I hope in the coming times we would get back to this level, and that the better sense would prevail, and people would stop, you know, demoting the SME segment. So yeah, so that was on the SME. Prince, any question as of now? Nothing.
So engrossing, no questions. As I think you complete the rest of the slides and questions. I'll definitely take at the end.
Okay, perfect. Now I think this is a very, important aspect, like, because every person gets attracted to markets. I mean, myself included, for the financial independence. So I mean, I have very different, viewpoint on this subject, because the way I made money was very different. So I used to be a risk taker right from the beginning. And here, my experience tells me that you need to have a commando's mindset, not a civilian's. See, financial independence in if you need to get it in a young age. Okay, then, like, if you want to have a breakfast today, right now, मैं आपको रात को अगर उसको दूं, how would you feel? कोई फायदा ही नहीं है. The terminal value of your net worth is basically zero, right? Terminal value of net worth being zero means कफन में जेब नहीं होती, right? कुछ नहीं लेके जाओगे. And the usability of money as you grow older reduces. A guy with $1 million at the age of 25 can do a lot of things than a guy with $1 million at the age of 45 or 50, right? So you need to first understand the time value of money here, that reaching financial independence at a younger age, when you can afford to take a relatively higher risk and everything, it makes much more sense than than regretting, not to take risk, and continuing with a very, very conservative strategy. And of course, a lot of things would depend on your personality, style, circumstances, and everything. But what I'm going to tell you is how I did things and what worked for me. So when I say you need a commando's mindset, this means is that you need to work in a high pressure zone. You need to work in a very disciplined and multiple strategy and a multiple time frame approach. Because in market, if you start developing a particular strategy, and if you start developing a particular framework, it will only work for a certain time frame. And once you change that time frame, different things would be working. So if you want to achieve this independence relatively quickly in your younger age, I would say even by the mid 30s is fine. Or let's target this financial independence things. You got to have it before 40. If you are in your, let's say, 20s or something like that. So how I would approach is I would first have a multi-strategy and a multi-time frame approach. Because if you see, uh, in the previous slide we spoke about positional trades, right? higher allocation positional trades are going to fetch you more. And I did, last time I met with Prince. We did a small podcast. You can find it on YouTube. That what I used to do was, I used to put capital in a single trade and used to work for a lower return percentage. So the quantum of capital you make is going to be same whether you make it from a 10x or you put a big chunk of amount and you go for, let's say, 30% return or 25% return. So you need to, decide on that. If you find yourself and your personality to be matching with this strategy, this is not a bad strategy to, pursue. I personally pursued this to get my financial independence. So this is actually the third point which I wanted to make is that, strategic use of allocation and churn is critical. Now, churn is a very negative word these days. When you talk to people, they say that, churn has a high cost, which definitely has, because you pay taxes, there's a government is your is a shareholder in that from your returns. So definitely there is. But my idea is you don't churn for the sake of churning. You churn to land on a winner, right? This fourth point, see this strategically churn shorter time frame trades to land on a longer time frame winner. What this basically means is that your eventual goal is a winner. Like for example, I bought Suzlon, right? I had to take multiple trades before Suzlon, which did not work, or which worked for smaller percentage, and I kept exiting that to land on a winner like Suzlon, where everything was working. So, churn till the time you land on a winner. And now that the question would come up, how to identify whether it's a winner. So, excellent question. I also used to have this question a lot. So this is where, studying past winners comes very, very handy. So what do you need to do here is this, that, you know, you need to focus all your mind, your energy on winners. That is where your needle is going to move, right? And I'll tell you, when I was starting in markets, after 1 year of observing everything, I used to feel very, very bad that why is this stock that has moved 5, 7, 8x in 1 year, right, is not in my portfolio. And even if I have it in my portfolio, why it is not with higher allocation? So this used to frustrate me because what I was observing is every year, some sector, some strategy, or some industry is producing a winner, right? But I was not having it due to whatever reason, right? So what made the change was I then from that time onwards, I just focused completely my strategy that my strategy is nothing but finding winners. Now to find winners, you need to first understand what the winners look like. ठीक है, तो ये बेसिकली अगर मैं हिंदी में आपको समझाऊं तो ये होता है कि ये चोर पुलिस का एक बेसिकली खेल है, ठीक है। अब मल्टी बैगर इज नथिंग बट अ थीफ, चोर है वो। अब चोर क्या करेगा जी, चोर कहते हैं ना कि लाइक व्हेन द एट व्हाट टाइम विल यू कैच द थीफ। एक तो होता है जो डीप वैल्यू इन्वेस्टर होता है, वो चोर को तब पकड़ता है जब चोर सपना देख रहा है कि मैं चोरी करूंगा, ठीक है। सो वो इतनी जल्दी आ जाते हैं उसमें, दीज आर अर्ली इन्वेस्टर्स, कि वो तब से उसको अपने उसमें नजराने में रखते हैं कि उसको पकड़ लेंगे जैसे ही वो कोई भी हरकत करे। अब मोमेंटम इन्वेस्टर कौन होता है? मोमेंटम इन्वेस्टर या फिर ये लेट्स से टेक्नो फंडा या जो भी क्या हो, ये लोग वो होते हैं कहते हैं इसको चोरों को चोरी करने दो, ठीक है, कोई नहीं, एक गली पता लगा लो जिसमें से ये निकलेगा, ठीक है, यहाँ से इसको पास करना ही पड़ेगा, तो वहां पे इसको पकड़ लेंगे हम। ठीक है, वहां पे जाकर के व्हाट दीज गाइस डू इज दे वो जाकर के सारा अपनी एम्यूनिशन लेकर के सब कुछ लेके बैठ जाते हैं वहां पे कि यहाँ से तो पक्का निकलेगा ये चोर। वहां से निकलता है, वहां से उसको पकड़ लेते हैं ये लोग. So the what I'm trying to explain you here is that your job is to catch the multi-bagger, right? Now the deep value guy is playing the percentage game. So this guy would make 10x their money, to 20x their money, 30x their money, 50x their money, right? On a relatively smaller allocation sometimes, or most of the times. Now, what you can do in this case is, once you have identified this looks like a winner, you let go the first 50-60 percentage. Even let's say मैं कहता हूँ डबल भी हो जाए, बॉटम से डबल होने दो, ठीक है. I'm giving let me give you an example. For Suzlon, I was tracking this stock for when it was like 8 rupees, right? When things started changing, and by the time the stock came to around 13-14 rupees, that is the time where I actually got in with a very high allocation, right? So I don't care वो नीचे bottom से कितना ऊपर बढ़ा. What mattered to me was that अब वो बढ़ने लगा है, फ्यूचर रिटर्न देखो, पास छोड़ दो. जो बंदा 8 पे लेके बैठा था 5% पोर्टफोलियो से, ठीक है, मैं 12 या 13 पे 40% पोर्टफोलियो डाल करके ज्यादा रिटर्न कमा लूंगा, राइट? प्रोवाइडेड I have identified the winner. That is the main thing, right? So what you need to train yourself on is, you need to identify the winners both numerically and like numerically via fundamentals and visually via charts. This is absolutely critical. Fundamentals, you need to see what is happening, what numbers are changing, what the EPS growth is, what the industry structure is, whatever anything is going on, right? And visually, you need to see what the charts are saying. Because charts basically tell you that what the smarter guys than you, they are doing, right? So this is, very, very important. Because see, lot of people say that charts are like, hunky dory thing, line बना करके कौन किसी के पैसे भी नहीं बनते. What you need to understand, see, this is that charts are nothing but the footprints of the smarter investors with a higher capital base. And charts are like leverage. Use them wisely. So for this, I think what I would recommend here is read Monster Stocks. So Monster Stocks by John Boyk is basically a book which tells you what the multi-bagger looks like visually. चार्ट पे कैसा लगता है वो, जो 7 8 10 गुना 20 गुना होते हैं ना शेयर्स, how they look on charts. So read this book to have an understanding of that. 100 Baggers by Chris Mayer is excellent book. Here you would understand what you know a consistently, how should I put it, what a big winner looks like. And a big winner, mostly it is nothing but a good capital allocator, right? So here you would have imprinted in your mind that what exactly, in the past 100 baggers looked like. So when you see these kind of traits happening again in what you're seeing currently in the market, then you first, you don't exit very soon, and the second is one, like, you allocate big money in that. And the third book is The Outsiders. The Outsiders, this book is basically, this is going to teach you how capital allocation is so important. Okay, how how the businessmen generally look, and how they think about capital allocation, how they are consistently right in not misallocating capital. Because see, what happens is that when a business starts making money, they have this tendency to diversify, right? In diversification, they get into businesses where the return expectations, and where the returns are not that great, right? This is where competition and competitive strategy and all these things come into place. And there is a I think there is a book by uh, this person called. Margareta. Yeah, Margareta, and this book is called Understanding Michael Porter. So I think this is one book that you all should read. This book is basically going to explain you how competition works, because competition is one of the most critical aspect in deciding long-term returns. Because simple सी चीज़ है ना, if you let's say अगर if I'm doing a particular business, right, but I'm let's say earning 30% return on capital or a 50% return on capital. It's natural, like in a capitalistic society, that there would be competition who would be, who would want to come in and take my market share. So you need to understand that aspect of that. So that book is, really nice. So yeah, I mean, financial independence is such a huge topic, such a deep topic. I mean, a lot of you would be, you know, uh, aspiring to be financially independent. So in case, Prince, I would just like to stop in case they would have any questions on this. I would, love to take.
So I think, Shashank, as of now, I do not see any hand raised, and which means whatever you have explained, they are absorbing and is indeed really uh, adding a perspective and engrossing as well. So definitely, we have two slides remaining. Once you complete, we'll
Okay,
have
okay,
question on the
okay,
slides.
okay. No problem. So I'll continue then. Yes. Now, I mean, it's off investing, but I think this is absolutely critical aspect of being a good investor and being, like being someone who would be able to enjoy the fruits of your hard work. See, the quality of life as you would age, it would be defined by health multiplied by wealth, not health plus wealth. A lot of people think that, if I get health, I just need to add wealth to it. Or sorry, you can say, if I all get all the wealth, then I need to just add health. It won't work that way. If health is zero, the quality of life won't be there. As simple as that. So try to understand the equation is health multiplied by wealth. And if health is zero, wealth becomes zero. That's normal. Now, I mean, not spending too much time because I'm not any of a fitness freak or you know you can say a fitness coach or anything. It is just the things that I have seen and that have worked for me that I can tell you what exactly it is. So what is basically fitness? मतलब ये जो शोर शराबा चल रहा है कि fit body क्या है? Is it muscular? Is it six pack? Is it what it is? See, you basically, if you need to live long enough, in a healthy way without breaking your bones or anything, what you need is power. You basically need to generate power to perform daily, you know, tasks, right? And you, on the other hand, what you need is you need a fit body to absorb shock. Like, for example, generating power would be like, to sit, to jump, stand, to walk, because you generate power to do all these activities. Now on the other side, you would need to absorb shock. So, for example, you get a someone pushes you, so you would have to find your balance. And so you need to absorb that shock in a way that you don't injure yourself. So how do we break down fitness? So breaking down fitness is based strength training, which is mostly the compound movements like a squat or a deadlift or things like that. So these are you know exercises that you need in your body to maintain the muscles, which will help you in generating power, right? Now, the second aspect of fitness would be cardiovascular training. The cardiovascular training, what it would do is it would increase the duration of transmission of power produced by muscles. So, for example, you want to do a particular task, you will be able to do that task for a longer duration if your cardio is in right place. So, what duration of transmission बढ़ाता है. And the third part is mobility of your joints and the flexibility of your muscles. Now, mobility of the joints and flexibility of muscle is it's like, it's like an engine's piston, right? So that would basically help you transmit that produced power for the desired duration very easily, because that's how your human body system works. Now, this very critical point, another one, is the metabolic health. So metabolic health is basically like a spark plug in a car. So this metabolic health element is basically is a bridge between your fuel, which is nutrition, with the food that you eat. This is where the metabolic health plays in, that in what time, how your body assimilates and absorbs this food, and gives you the required energy. Fasting is one way where you can actually correct your metabolic health. And of course, if you don't have any serious ailment or something, that has personally worked for me. And for cardiovascular one, zone 2 exercises are pretty good. Quickly Google it, zone 2 exercise, you'll get more information. Than mobility in joints and flexibility of muscles. I mean, yoga has tremendous potential, because see what happens is, average healthy body. If I explain you in the investing parlance, you are basically sitting on a muscular operating leverage. A, a muscular operating leverage, basically what it means is that uh, you have a muscle in your body, right? Now, in order for you to fully utilize that muscle, like you say in investing, capex utilization, we have empty, capacity. We need to utilize it fully. So, in order for you to utilize your whole muscle, you need to make it flexible, right? So, what yoga does is, yoga uses breath and the stretches to ensure that you have the desired flexibility of that muscle. So, like, for example, if you let's say, if you throw a cat from, let's say, height, it would quickly turn its spine and suddenly get up very easily. So that kind of flexibility in the muscle would let the cat absorb the shock of throwing from, let's say, from the first floor, or a very small height, and then suddenly get up. Same thing is, basically, you can actually train your muscles for this flexibility through yoga. And I personally think that it's a great fitness activity that you can actually include in your daily routine. And one last point I wanted to make was the mental health. Mental health, I think pranayama and vipassana are amazing. Personally, I mean, the pranic philosophy, if you see, it's a very interesting fact. See this. So what the pranic philosophy says is that your number of breaths define your lifespan, not years. And the proof of that is, a fast breathing dog has a shorter lifespan than a turtle, right? Dog lives average 10, 12 years. Turtle, on the other hand, can go up to 300, 200 years. What is the difference? Turtle is basically breathing, zero point 0.5 breath per minute. And for a dog, if you see, it's quite high. And for human, average healthy human, you're breathing, 14 breaths per minute. So that comes out to be 20,160 breaths per day. Now, practicing pranayama for 30 minutes per day reduces your breath rate to one per minute, because you hold your breath, then you inhale, then you exhale. Everything, that's what you do in different ways. So, what you do by 30 minutes of pranayama every day is, you are saving 390 breaths per day. Now, practicing every day for 1 year saves you 319 to 65, 142,000, like 1,42,350 breaths per year. And now, if you do the math, and for 142,350 divided by 2160, 7 days of your lifespan per year. So, what this means is, 30 minutes of pranayama every day, you add 7 days to your lifespan. Basic pure math. So, that is the power of, breathing right. And there is a book by James Nestor called Breath, which basically highlights the importance. I mean, this all, I mean, our yogic and the Indian philosophy has written everything about it. And it's just that, I mean, we still have to look at the West to approve it. So I just really hope that people who are into this invest in the investing community at least take this pranayama part very seriously and have this included in your schedule. 30 minutes is nothing, so but with a lot of benefits. So Prince, I think that is it from my side.
Perfect. So, okay, we go with Shami first. Shami, you can unmute and ask a question. And for other participants as well, like one by one, you guys can, if there are any questions related to the slides or maybe anything related to investment, we will be happy to address those. So, to start with, Shami.
That was lovely. Thanks, Prince, for giving this opportunity. Hi, Shashank.
Hi
Shashank,
Shang.
yeah, my question is like related to the time correction. So, if you have been taken the position with this all factors like which has been sectorial and other factors have been benefiting into that particular business, and stocks in spending to same range bound in the time correction, how do you going to handle? And the same case if you added the market conditions, for example, last 1 week the market has corrected. So in this situation also, how do you manage your position even if you have been taken 22% of above allocation particular script?
Hmm. So first thing, Shami, would I would say is first you need to identify where you are in your financial independence journey. So, for example, if your immediate target is financial independence, then you need to be relatively more agile in only sticking to the winners, right? So that is first thing you need to decide where you are in your journey. For example, of already financially independent person would have a higher time frame, higher, let's say, higher tolerance towards a stock that is in a range bound, but not like for life. It's not for like you cannot sit on a position for, let's say, 1 year or 2 year or things like that. Ideal time frame is to give 1 quarter. At least 1 quarter you would understand what if your business is performing or not, right? So that is one of the factors that you need to take into consideration. Now, if you are, or if you have not reached your financial independence, and if you're, because capital is all what you have, in that particular case, I would highly recommend to take a longer, sorry, a higher allocation position only when the earnings triggers have started showing in. Do not be very greedy that I want to make a very huge high percentage return per trade. Be more focused on getting the trade right first, and adjusting the allocation after that. Because see, the thing is this: your impact cost means you would not be increasing the price by 10-20 rupees by just buying your average, like buying your desired quantity. So in that case you can also wait for a little time to ensure that you're in the right stock and later increase the allocation. So that is how I would play it.
And market conditions also, when the atmosphere has changed all of suddenly, how do you handle the situation?
So market conditions would be like this. So definitely market conditions keep on changing, and the sectors keep on showing strength and everything. So you need to keep an eye on sectors that are falling less on bad news, right? Or are the first to jump when the news flow. So basically, that a relative strength tool is a great tool where you can find it. Let me give you an example. See Lotus Labs
Mhm.
recently. Lotus Lab had a again terrible quarter, right? Bad quarter, bad figures. Did,
Yes.
did the stock fall? No.
No.
Next day, छोटा हल्का सा गिरा, कितना बड़ा jump आया. So these are the signals that you need to look for, right? So these are the signals are basically telling you that the worst is over. That the market is saying that despite bad number stocks don't fall, this is a signal to you that okay, you are on at a decent level. So yeah.
And one more question, Shashank, which related to the SME and small caps. So
Mhm.
the recent SEBI regulations, like stock yesterday, if it is a 5% circuit, next day it is a 2% circuit, and which is disturbing the momentum catch up. So
Mhm.
how, if you are been comes under that trap, so what you going to do? The stock turns to the 2% of lock circuit. How do you
See,
see? Yeah.
SME investing, firstly, it is only for those investors who understand the business well
Mhm.
and the promoters' integrity and everything. They have a very, very, clear viewpoint. It is not for everyone. This is only for the diligent investors who are doing their work, tracking the industry, have some kind of a means to connect to the management, and then putting their capital at risk. For an average Joe
Mhm.
in the market who does not have all this experience or does not has that network, right? I would not shy away in saying that you can skip SME.
Okay.
See, my idea is this: SME is not bad. Discouraging SME investing blatantly is bad, right? What you need to encourage is, if people have the network, if the people have the bandwidth to analyze the company and the promoter, be all in, be go and put your risk capital. You're going to make substantial return, right?
Okay. Yes.
So just be mindful of what you are in for. Don't be attracted only by the return. Also look at the risk. See, the risk of ruin of company going zero or getting delisted also exists here, right?
Yeah.
So you got to be a little mindful of that part. And
Mhm.
yeah, that's how I would say. But the current, if you're asking me what the current scenario is, see, the current scenario is very simple. Sentimental sentiments had a froth in
Mhm.
stocks, right? Froth comes out based on the negative sentiment and comes in because of the positive sentiments. But at the end of the day, if the company is able to deliver the earnings, you are going to make money. And let me give you another framework for SME, how I think. See,
Okay.
let's pick up an example, a solar EPC company, because it's a quite famous these days. So how do
Yeah.
you look at a solar EPC company which is an SME? The solar EPC company as an SME, what you got to do is you need to take three frameworks. First framework is, if I have to buy a solar EPC company, what kind of a multiple I would like to buy it for as a merger and acquisition. This is number one. Second thing is, how much money does this company make, or or is expected to make in the coming future, right? So now you merge these two things. So for example, if a company is today, a solar EPC company, trading at 100 or 150 PE, right?
Mhm.
Now the right way to look at it is, you give the PE to a business according to the business's quality. So let's say, if there is a down cycle right now, okay, there is no solar panel demand, nothing. What
Mhm.
PE would you give to a solar EPC company? I would say a PE of, let's say, 15, okay,
Yes.
according to the profitability. Now
Yes.
this company is trading at 150. What do you do? So how you would think is that you would say that, let me give the PE of 15, which is a down cycle PE, right? And
Mhm.
now let me see what the earnings are looking like. Down cycle PE ratio and the peak profitability. You multiply these two and you get the market cap. Let's say a company, you say, is going to make 500 crores of profit, right?
Mhm.
And you say that this company is to trade at 10 PE when it will be in the down cycle. So what the
Mhm.
market cap comes out to be is 5,000 crores,
Yeah.
right? So
Yes.
this is how you think,
Okay.
that peak profitability multiplied by down cycle PE is the ballpark figure of what the company is going to trade at in the coming times or the years once the cycle is over. Now, the real art here is identifying the peak profitability. See, this peak profitability is going to depend on your judgment of the tailwinds.
Mm.
This 500 crore profit that I'm taking, let's say company is making 10% margin, right? 10% margin, this would mean that 5,000 crores of order book, 500 crores of profit, right? 10K P पे 5,000 crore का market cap. This is your ideal market cap. Now, what you need to think is, can the company make more than 500 crores of profit or not? Is there an optionality coming in? Is there some kind of a trigger coming? Is the tailwind that I'm imagining is stronger than it is, right? Can this 500 crores become like 2,000 crores of profit in 5 years down the line or 6 years down the line? In that case, your market cap calculation, completely changes. So this is, I think, one thing that you got to, be careful of and think about.
So one question is from Satyam. Shashank is asking, is there any market cap limit above or below which you don't invest, or your market cap?
I'm actually 100% cap agnostic. So if I find, and generally my way of approaching is, if I get something in the mid cap zone, my propensity to increase my allocation is at relative ease because my impact cost is low. Impact cost means that if I have to enter and exit the stock, I would not have to move the price too much to execute. So in that sense, my allocation is relatively higher for the mid or the larger small caps. But if I go towards on the SME zone, then I do not tend to take that approach of 40, 50, 60% of allocation straight away. So yeah, I that's how it is.
Shashank, on the who you are part and talking about the different time frames, I mean,
Hmm.
understanding what you have explained is comparatively easy, but the challenge what normally the participants or the retail investors face is how one can, I mean, easily find out who are we, because it is, and when we enter the market, it takes n number of years before we realize that what's actually happening in the market. There is always a certain time to it, right? Some can learn in a shorter time frame, and some people take longer than ever. But again,
See.
broadly,
Mhm.
what would be your take on that? How we can easily, or if not easily, in
Mhm.
a better way, identify where we are and what time span suit us, so that we can set our framework.
Yeah, see, so Prince, I mean, I will tell you what I did, and I would not say this is the right way or the wrong way or whatever. I can tell you what I did, and you can extrapolate what suits you or the investors. So see, first thing is, without even trying, you will not know whether it is made for you or not, right? So here, what happens is that, for example, I'm giving my personal example. I have done F&O trading, derivatives, mostly futures, less of options, because in options you have more variables at play. So I have done that. I know now what is the time basically when futures or playing in derivatives makes you money. Secondly, I have also done, I mean, intraday. I would not say I've done too much, but it's like I did, but I immediately realized it was not for me. Right? It was too much of screen tracking and everything. Absolutely not for me. For different positional tradings, initially I also came to the market with the viewpoint of being a long-term investor of like 10 for like 4 5 6 years, and I wanted to have this big multi-bagger thing and everything. But eventually I realized that my capital size is giving me the flexibility to have a different time frame approach. So what I used to do was I used to take into consideration the time period in which the trigger would play out. I would allocate high and then, get out and take my profits and reinvest it elsewhere. It is just like, like when you're running a business, you would say that, okay, there's a good order coming in. Let me take this. It has a good margin, execute it, and then, yeah, we will look for another client. So it's think something like that. So my real advice, if I have to give one, is to allocate a small, let's say 5% of your portfolio to a particular strategy and see how you are, reacting to it. Because you see, the ultimate feedback and the ultimate right strategy for you is going to be the one where you are, comfortable, where you are feeling at ease. Like I was feeling very much at ease in the beginning when I was doing a shorter term, positional trading, because my capital was small. I could see incremental growth in my portfolio, and I was, reasonably very content. And as the portfolio grew, I was only concentrating on big winners, because now, I mean, playing only for shorter terms was not making sense to me. But again, it would depend on the market conditions. It would depend on the economic conditions. It would depend on a lot of things. So today, let's say if there is a scenario where I'm not able to find a big winner, will I not do the smaller time frame trades? No, I will do it. It is not stopping me. So, that's how I, basically think. Do try, learn about a particular way of doing investing, and then see what is suited for you.
Perfect. We have another hand raised. Yeah, Sheikh, you can unmute and ask your question, please.
Uh, Hi, Prince and Deepak. Thank you for giving me opportunity. Prince, can you able to hear me?
Yeah, please go ahead.
Yeah. Deepak, how do you handle the drawdowns, which is in case of market risk and business risk, if it is in large drawdowns, and also the style of investing you mentioned, right, from the day trader to the ultra long-term reach investor, right, time frame from day 1 day to 10 years horizon, right? While we are exercising our trying to find out ourselves if we invest and if we get into a big drawdown or loss, how do we handle that? Is it like exit despite of that at the end of the time frame, or is there what is the way you handle it? Can you please tell me?
See, your ability to digest a drawdown firstly would depend on your allocation size. So, I mean, let's say if I put you put 1% of your portfolio in a particular stock and it goes 50% down, it doesn't make a huge impact on your portfolio. So the basic human instinct would be that you would be relatively more comfortable with that kind of a drawdown. But if you're putting 20% or 25% of your portfolio into one stock which is going 50% down, then you would have sleepless nights. So first thing is allocation. Now, your ability to deal with a drawdown would depend on the type of investing you have done. So type of investing means if you're for a super long term, like for example, Charlie Munger, Buffett says that what Charlie Munger used to say was, if you're not able to see 50, 30, 40, 50% drawdowns in your portfolio, where the market excesses go down, you are not basically fit for a long term investing, right? So this is where you basically need to, do some soul searching, that what is my time frame. Let's say, for example, let's say you are coming in for the market for a time frame of 3 months, right? It would be stupid for you to suffer a 50% drawdown. You should be the one coming out of the, out of the trade relatively, let's say, I mean, my magical figure would be, if it is a really shorter term trade, 8%. With 8% or 10%, you don't, lose too much to gain it back from the market. So again, it would depend on what time frame you came for, and that will decide your drawdown ability, your ability to digest the drawdown. But drawdowns are part of the market. You got to be trained for it, and you got to design and allocate your capital accordingly. So yeah, that's how I would put it. And as a suggestion, I would say that if you are starting to invest, and if you're starting to, let's say, like on the path of finding a winner, or a winning stock, start small. Do not go all in one go. on a stock, start small, and then eventually, make up, like, average up. So that way you would be more comfortable in, like, holding on to the stock, and will give you lesser sleepless nights.
So, Shashank, one follow-up on this would be like if you have all the strategies right and the company is fundamentally good, the technicals also appear to be good, but there is a broad market correction. Although recent one is not a correction, it's simply a volatility. 6, 7, 8% of Nifty is nothing. But again, we have seen that many companies have corrected some 30, 40, 50%, right? In such cases, when you allocate big on one or two positions, then definitely uh, when the market as a whole is correcting, there would be a big dent on the portfolio, and you never know whether it's a short-term volatility or that is going to last for a longer period of time. So, in such situation, or be it hypothetical or so, how you would be behaving? Would you be strict on your stop losses, or you allow your investment some time because all the checkpoints are there in place? So, how exactly you go about?
See, it depends. So, first thing is, have you entered it? If you have entered the position on the basis of fundamentals, on the basis of fundamental triggers, and you know that the triggers. So let me put it this way. So let's say if you're having a deep value approach, right? So deep value approach ideally comes at a point when there is a lot of, either pessimism or the market conditions, and things are still in a developing phase. So now, if you're coming at that phase, I would suggest that you digest the volatility, because you are the one who's going to make the base for that stock. But if you're coming at a stage when the earnings triggers are already there, right? The triggers are happening in front of you, and still if the stock is falling down, I would say relatively reduce the allocation at that stage, right? And come up once things stabilize. You can then you can actually increase the allocation accordingly. But when every stock is following and your stock is not just the only one, which when it is a sentiment driven selling, my personal suggestion would be to hold on, because sentimental driven is more like, for example, let's say, a stock can fall not because of its fundamentals or technicals. It could just fall because there is some guy who called up for the margin. This recent news of margin trading funding going on, like margin traded fund, and then the government putting a ban on that, and all that thing happening, this can impact the stock price. Like, for example, let's say if I'm an investor in XYZ stock, right, and I have bought that stock by, pledging my shares of a large cap stock. Let's say, let me give you an example. Let's say I have, one, 1 crore position in Reliance, and I use that position to take some money from the market, right, as a loan, and I invest in a particular small cap stock. So tomorrow, if Reliance opens 5% down, what my broker is going to ask me is that, boss, I need money. So now in that case, you got to sell your small cap stock, whatever stock that you had. So these are the scenarios where you also need to understand what kind of selling you're facing. If you are someone like not yet financially independent, who is very sensitive to volatility, I would say reduce immediately your position size, let the clarity emerge, and then buy it again. No harm in doing that. But I would say that it's a personal call, and how I deal with it in a way is that I would first see what my what my the thesis for going into the stock is. If it is a shorter term trade, I would exit, like, not fully, but I would trim that position. Once the clarity comes in, I'll get back in. And if it is something that I'm reasonably confident that I am playing that deep value game in this stock, then I would, fine. I'm fine with volatility.
And how you assess the current scenario happening in the market going forward? Do you think the volatility is going to last, or I mean, your
Well,
assessment is something?
see, volatility is going to last or not. I mean, no one knows, to be honest. I won't like act like a godfather saying I know what's going to happen. But what I personally like in this market is that, the price action that is happening in pharma. So especially the Lotus Labs. I mean, it was amazing. I mean, stock results were bad. Way it opened up, and then it moved up. Means accumulation going on. I mean, no recommendations, nothing. And please do your own research. And but I'm liking the price action that is happening in pharma, because accumulation. It looks to me that accumulation is going on. So that is one thing. And yeah, I made some lists of things that you like, that I like was currently. One is this the CDMO and the pharma theme that is going on, and the other one that I like is the anything that has to do with artificial intelligence and its infrastructure. So on that case, let's say for example, any ecosystem that is being developed in India to facilitate AI, or like right from the semis to the chips design and manufacturing and everything, and anything around that. Or if let's say there is a like some SME companies also, they are doing really great work in you know power transmission and everything. And that is something very very looking very interesting to me. And one thing very surprising, and not surprising, but one thing very worthy of noticing is power transmission. So if you see power transmission stocks, for example, TRIL and Silchar and all these transformer companies, they are showing a very very healthy price action. So what this basically means is that we are not yet done with our power capex. So we can debate on what kind of energy or renewable energy is going to be, what it's going to look like. That let's say a larger enterprises with the huge power needs might go to let's say hydrogen or nuclear. Smaller ones would stick to a blend of solar and wind, and for their power needs. And the like regular households, with given that India's positioning on the have we have so much of sunshine available, they all might look for just solar. So, I mean, that ways you need to look. Energy transition is a theme that is, you need to pay really good attention to. But the safest in the value chain, what I see from the recent fall in the market is transmission. Transmission and anything to do with developing the infrastructure on the, power transmission. That is one space that you got to pay attention to. So, yeah.
So another question is one of the participant asking how you ride your winners at its full potential without cutting early. How you handle the anxiety during the winning investment?
The simple answer है मरे बिना स्वर्ग नहीं मिलता. It is, see, volatility is a part of the game. You really cannot. Uh, right now, let me put this way. Right now, I'm more tolerant towards volatility. But initially, when I was starting, I was not, because my capital was small and I was executing, trades where only there was super strength. So what I used to do was, and I still do partly, not very deeply, but partly is the momentum part. So where you get the momentum right, in stocks, where you are where there is a high level of strength, there you put high allocation. There you put high allocation, and then you make, even if it is a smaller return, and then come out, and relatively less tolerant towards volatility at that phase. But now, God's grace, if the once the capital size has grown, I'm relatively more tolerant to that. But riding
So
a winner,
which
so riding a winner. So coming back to that question, second part. what makes you feel that the stock is not yet, like, nothing is, like, it's not yet over, is basically reading about the mega trend that is happening. For example, renewables. In renewables, I was doing this certified course at this place called Corporate Finance Institute, right? If you Google it, CFI, you will get it. So I would highly recommend, if people who are genuinely interested in financial markets, just sign up to this, wonderful, course they have. They have course for everything. They have course for valuation. They have course for capital market. Like, if, for example, if you want to be a trader, they have courses for wealth management. They have courses for private equity and everything. Every damn thing that you can think of investing, they would have a course on there. Then they have very, very good content. So that was a time when actually I was doing this course, which was related to ESG certification. So ESG certification over there was there. Basically, I was getting a trigger that what exactly is happening. They were teaching. They taught you in that course that you can, how the companies would be forced to actually have their green, what do you call this, carbon credits counted, right? So if you're operating a business, you would get certain carbon credits depending on which energy you're using and everything. How you're they are blending that carbon credits to your balance sheet. So when I was doing that, and I said that this is the level of depth they are going into, I said every company sooner or later would be running around to buy renewable energy. Now, renewable energy can be debatable, solar, wind, whatever, but renewable energy is there, is the future. Now, you look at the policy changes that the government of India was doing. It was wind, right? And recently, after 1 year, it became solar. So then change gears from wind to solar, and things like that. So that is how you read. You got to read. You got to build your conviction, and that is how that is the. I mean, that's what I can think of. That is the only way, you know you know that's how I did it. I put it like that.
Right. Shami, go ahead.
Yes, thank you again. So, Shashank, the recent numbers which is delivered by IT companies, most of them are been is giving good commentary also. So, I think this sector is again coming into the momentum. The stocks also performing well despite of last week. How do you see this sector next coming few quarters? I mean, few quarters means like next 1 year of period of time. Is it like
Everything depends on, the mother market for the IT sector. Again, I mean, depends on what part of IT you're talking about. But I would recommend, if you want to really have an expert subject matter view, Amia would be the right person, because he knows the sector quite
yes?
well in and out. So he can explain you the sector intricacies. So I can give you a bird's eye view, because I'm not a sector expert, or I mean, I don't have a huge positioning in the sector. So what I can think of and I can tell you is, the mother market for the IT sector is the US, right?
Hmm.
So let's say, there is one thing that Trump comes to power, right? And
Hmm.
Trump makes some kind of a thing that, they would have some kind of, trade negotiation and everything. Some sort of thing happens where the trade on the farmer or the IT gets impacted. This is one way of looking at it. Second way of looking at it would be that, if what happens after the US presidential elections to the US dollar. Do we
Mm,
start the fall of the dollar and the de-dollarization? Do BRICS currency come with a note, with their own currency and all? So, I mean, the thesis is what happens to the dollar, because eventually the earnings of these IT companies is in US dollars, majority of them at least. So that's how I would think of. And but I since I cannot, I'm not tracking the companies very closely on the business level. I do not know the trigger. So that's how I would put it.
So, Shashank, one question is from the participant is asking, reading the book is one thing, but implementing those learnings from the book is a challenging task. So how you cater to that, or what would be your suggestion or experience on those?
It's a very interesting question, actually. This is the problem that I face also. See, every book, a good book, is going to teach you something new when you're going to pick up. Like, I have a lot of books which I picked them right now, teach me a very different things than what I did when I picked it up, before. See, understand one thing, that investing is a very, very dynamic profession, right? And the dynamic profession is, the nature of this profession is that since it is very much psychological, you need to reread things a lot till the time you have seen enough cycles that it gets imprinted in your brain, right? So, I mean, let's say there is a book on megatrends, right? Megatrends speak about that, something new which is making the human lives easier is a megatrend, or something new that is catering to a latent demand that is existing in the market is a megatrend, right? The first time you will read this book on megatrend, you will not learn much, because until and unless you have seen a megatrend yourself happening in front of you, then when you pick that book again, you learn more from that book. So, for example, trading books, market wizard books, like by Jack Schwager, right? Once you start investing, when you start trading, once you get a loss, when you get a winner, right? Then again, when you pick those books up, how these people were thinking when they were losing money, how these people were thinking when they were making money, right? So that is where you'll be able to assimilate or relate to that book more. Like, for example, in the Market Visit book, there was a chapter by Stanley Druckenmiller, and he says that, invested in stock markets during the crash. I was out before the crash, but then again, due to greed, I entered into the crash. Now, if you haven't seen a crash, you would just remember that conversation. But let's say right now there is a bubble going on, or a big bubble going on, like just like it was going in 2001 and 2 in internet. It's going on in AI or in Nvidia or anything like that. So these same things come back to your mind, that I should be careful in entering at these valuations, right? So that's how you only cement the learnings once you have seen those things happening in front of you. Investing books are not about like learning them by heart. You read, you see what is going on, and then it's a step by step process. It's like it's not overnight. That's how I would say.
Perfect. So, Sashank, before we close for the day, anything
Yeah.
you want to say to the retailers at this point in time? I mean, obviously they are anxious, and say tomorrow is Monday, and
Yeah.
majority of the people
My
have a
closing remark would be, see, be as unique as possible. Stock markets exist because for every buyer there's a seller, right? Be unique, because you can be on the buying side one day and you can be on the selling side someday. Do not criticize any strategy, because your existence depends on existence of that strategy. Let me give you an example. Let's say every person is a value investor. Every person is a value investor, right? Everyone wants to buy low and wants to sell high. Now tell me one thing: when you're going to go to buy, will there be anyone to sell if everyone is a value investor? The answer is no. The whole idea of stock market collapses when there is no diversity of strategy. So take this thing very carefully, that every strategy has a right to exist. Your strategy should be unique to you. The uniqueness to you defines your strategy. That is it. There is nothing more, nothing less. Be unique, be focused, be disciplined, and yeah, I mean, do good. That, that's
perfect,
that, that would be.
Shashank. Thanks for taking out time, man. And it was a great session. So engrossing,
Okay.
I would say, and definitely our audience would love this when I place it on YouTube. And the participants here also had their set of questions, and you answered them pretty well. So thank you so much for your time, and definitely look forward
Thank you.
to many more session interactions with you.
Sure.
Okay.
Sure. Thank you. Bye-bye.
Thanks